Mr. Devrhoid, we're very happy to have you here. He is the co-founder and the CEO of Caribbean Value Investor Corporation, and also he's a stock market analyst, which is what he'll be speaking to us about today. And he also has his own YouTube channel. He's the host of the YouTube channel Beyond the Stock Price, so we could all subscribe to that YouTube channel and watch his page. He is only 27 years old and he has a vast pool of knowledge to share with us, so we're excited to have you here. And without further ado,
thank you, Christine. I appreciate that. Okay, so good morning, everyone. Thank you again, Christine. Thank you, Kemal, for the opportunity to talk here. As Christine said, I am the co-founder and CEO of Caribbean Value Investor. Caribbean Value Investor is an independent equity research firm that is solely focused on equities at this point in time. Eventually, we're looking to actually scale into doing like Forex as well as commodities. I myself have been involved in commodities in the past, and that's something that I'm very much interested in. I've also been building up competencies and also surrounding myself with surrounding my team with competencies in blockchain, especially with the wave in cryptocurrencies and all of that. So today, really what I want to talk to you about is the Jamaica Stock Exchange and stock market investing in general, as well as the opportunities that lie there, how you can get started, and some of the considerations that you want to take into account when you decide to invest in, say, a particular asset. In this particular situation, equities. And then lastly, I'll be talking with you briefly just about what are your goals, and then how can the Jamaica Stock Exchange and how can investing actually help you in achieving those goals. Alright? So the first thing that you probably want to know is what is the stock exchange and how the stock exchange actually works. Right? So the Jamaica Stock Exchange over the last 5 years has returned about 230%. That's the cumulative return of the exchange. The stock exchange was voted the best performing stock exchange in 2015 and also last year, 2016, when the return of the combined index was around 30%. Today, the return has also been around 30%. What that means is, if you had bought all the stocks or the combined index, and fortunately now we have indices on the exchange. In 2013, when I started investing, there were no such thing as index funds or even pooled managed funds that you could buy shares in. Your only options were either unit trust or then mutual funds. All right? So the stock exchange is an avenue for companies to actually list, raise funds, and it allows for investors to participate in those companies. So that's effectively what the stock exchange is. In essence, a stock is really just a certificate that signifies ownership of, signifies an ownership interest in a particular company. So you may think of it like the certificate for your car, the title of your car, the title of a house. So whereas the title of your house signifies that you own the house, or the title of your car signifies that you own the car, the stock itself is a certificate that signifies that you own a part of the company. We call it equity. Alright? Now how the stock market works is literally by a bidding system. So a company may list on the stock exchange. But how do you actually get to purchase shares in that company? So the first thing you would need is what we call an equity account. So the equity or a brokerage account is an account that is used to hold equities. It's what you hold your stocks in. So your bank account holds cash, your stock market or equity/brokerage account holds your equities. Another thing I should mention is that your equities are considered to be assets. Alright? We all understand what an asset is versus what a liability is? Yes. Awesome. So once you have your equity account.
You should speak on that topic. I don't think everybody understands what asset is versus a liability.
Alright. So frankly speaking, an asset is something that
I'm going to use the rich dad definition. So there is a academic definition, meaning an asset is something that you own. All right. Strictly speaking, I do not agree with that definition. My definition, which is adopted from the rich dad school of thought, is that an asset is something that makes you money whether you work or not. So, for example, if you own, and this is why stocks are considered an asset, because if you own stock and the stock pays dividends, and we'll talk about how you earn from stocks, but if you own stocks, then if the stock is of a company that pays dividends, then you will get your dividend payment so long as it's agreed on and declared by the directors, regardless of whether you do any work in the company. In fact, a lot of us who own stocks have never even visited some of the companies, as in their offices, and certainly have not worked for them. Not to say that you can't have stocks in companies that you work for. One of the things I like to tell people is that if you work for Grace Kennedy, you should probably buy Grace Kennedy stock as well. And so talking a little bit more about what an asset is versus a liability. So we say that an asset is something that makes you money whether you work or not. So what's a liability? A liability is something that costs you money whether you work or not. Are your bills a liability?
Yeah.
Strictly speaking, yes. Because whether you work or not, the bills are going to come. Alright? Provided you're still utilizing that service or occupying the space, right? From an academic standpoint, you're a financial advisor, which I am not, all right? So I'm not a financial advisor, but a financial advisor will tell you that your car is an asset simply because it has a value and you can resell the item. They'll also probably tell you that your home is an asset. And to some degree, I will agree with your home being an asset, because if you, for example, own your home and you're able to rent 2 or 3 rooms in that house, and this is the situation for my mentor, and you're renting it in such a way that the rental income that you're getting covers the mortgage payment and in some cases some of the bills associated with maintenance of the home, then you're in what we call a cash flow positive position. And that's the aim of owning assets. You want to have assets that are cash flowing. These are not the only types of assets you can own. A business is an asset. All right? If it is generating income and if its value is increasing, say, year over year. All right? So that's the blank description, or rather the strict distinction between an asset and a liability is that one will cost you money whether you work or not. The other will make you money whether you work or not. Alright, we're good with that? Alright, so going back to how the stock market works. So let's say, for example, you want to buy stock in NCB Financial Group. We talked about you needing an equity account first, right? The next thing you would need to do is to then send an instruction to your broker, for instance, telling them that you want them to purchase shares in NCB on your behalf. Otherwise, you can go through the numerous online platforms that exist. So the Jamaica Stock Exchange has a platform known as JTrader Pro. The URL for it is jtraderpro.jamstockx. That's jamstockex.com. Mayberry has their own online platform, and JMMB has their own online platform called Moneyline. Alright? So once you have a brokerage account, you are now able to purchase equities. Once you have an equity account, you're now able to purchase equities in these companies. So, and there's a whole lot that goes into selecting equities, and in the Q&A session we'll actually talk a little bit more about that. Alright? But I'm going to just make a segue here into how you benefit from owning stocks. And I alluded to it earlier, but one of the main ways that you benefit is through dividends. We call this getting a return. So that would be the cash flow aspect of owning stocks. So like a company like NCB Financial, for example, they pay around 2 to 3% in dividends. And the dividend is a cash payment that the company makes out of their earnings to you, the shareholders. Alright, so it's an actual check that you get. You also have the option for them to deposit it in a bank account of your choice. Alright, so that's a dividend, and that's one way that you can make money from stocks. The other way, and probably the more publicized way that you make money from stocks is through what we call capital appreciation. So what's capital appreciation? That is where you buy a stock for X, it goes up by Y%, and you're able to sell it at a profit. That's called capital appreciation. It's where you're making a gain on the money that you invested. A caveat that I should mention as it relates to capital appreciation. When you buy stocks, there are fees associated with that purchase. Typically, the percentage ranges from about 2 to 5%, depending on the broker that you go with. I can tell you here that NCB is the most expensive broker to be with if you're buying stocks, all right? NCB Capital Markets specifically. Other companies such as Barito or Sagicor or JMB may charge 0.75% in terms of a commission. There are additional fees that are charged by the Jamaica Stock Exchange, but these are minimal. It's about 0.2% in terms of assessed fee. There's also a standard trade fee, and then there is GCT because we always have to pay the government. All right. Important point on paying the government. Taxes are also charged on your dividends, but it's limited to 15%. Whereas like corporate tax rates are around sometimes 25 to 33%. And personal income tax.
So you all didn't know, we don't keep the money that we make. We pay 30% of that to the government.
Good.
Just for knowledge. You think, you know?
Yeah, when you see all the big money coming in, that's called the revenue. The government takes on 33.5 and a 30% of that. And so this is what you owe us for the privilege of being able to operate in our island. Yes.
In case you didn't understand that, this is know about how things really work.
And the government has subtle ways of taking up to 50% of that money.
Oh, 50.
Yeah.
GCT is one.
GCT is one. Asset tax is another one. They have some other taxes that they can.
The things are maneuver, monthly statutories.
Exactly.
Statutories, paying salary.
Yeah.
So about half of what they make.
And that doesn't include paying salaries.
Oh yeah, it doesn't include that, or light, or rent, or yeah.
Yeah. So I can tell you this: that some of the best performing companies, their gross margin, which is what the gross that they make after paying the taxes and everything, is around 30%. The best companies. All right. A typical manufacturing company makes about 4 to 6%.
Grace is about 5 or so.
Exactly. In terms of your net profit. Of the total
5% goes somewhere, and they keep 5% at the end of the year, just because of the work, the nature there.
Oh, the expenditure.
The expenditure.
Yeah. So the government taxes you as well, even though you're not necessarily doing any business. But for the privilege of being able to buy and invest here, you also pay taxes, and that's 15%. The good thing is that the taxes on capital gains, which is when your stock goes from $1 to $1.50 or from $100 to $200, is less because you only pay the transaction fees on those. All right. In some cases, you have to actually account for that when you're doing your personal annual returns, and some of you should be in the position where you actually have to state your personal annual returns if the company doesn't take care of it. Like contractors, for example, they have to do their annual returns, and then the government will decide, okay, how much of your money do I take? All right, and it's based on the nature of how you make that money. All right. So again, two ways how you make money in the stock market. The first would be the dividends, and the second is the capital appreciation. All right. When we talk about the stock market, we also, and very importantly, have to talk about the risk. So what are the risks involved in investing? The first risk that you face is capital depreciation, where you buy a stock for $100 and it goes down to, let's say, $90, because then you would have been seeing a net loss on your portfolio gains. And it's important for me here to state the difference between a portfolio gain and an actual gain. So portfolio gain is what you see on the statement of your account. A portfolio gain can be converted into a real gain, meaning real money, if you're able to sell the stock and materialize that portfolio gain. If not, I tend to take the portfolio gains with a grain of salt. Reason being, stock prices are volatile. Today a stock can be up 20%, and because of a rule that the Jamaica Stock Exchange has, in any one day your stock can go down by a maximum of 32%. So how that works is the JC circuit breaker rule prevents you in a way from losing all of your money in a single day.
Oh, yeah, sure.
In the US, there is no such rule. So one advantage of investing in Jamaica versus buying US stocks is that you are somewhat protected. In the same way, did you know that the bank insures your money up to $600,000 per account, per institution? Alright? So one of the things I like to tell people is that if you're saving money, don't save more than $600,000 in the account. Alright? Split it across multiple institutions. Alright? So we're talking about the risk involved in investing, particularly on the stock exchange. So we talked about the first one being capital depreciation. And the second risk is the potential of having no cash flow. Meaning, no company is obligated to actually pay a dividend. And I want to kind of end the conversation talking about risk because it's very important. So when you buy a stock, it's important for you to note that even though the stock might pay a dividend, it is not guaranteed. A company is not obligated to pay dividends. And this is irrespective of whether we're talking about an ordinary stock or a preference stock. I'll explain the two differences. So basically, an ordinary share is where you're participating in the risk involved of the company. So what that means is that you're taking on the same risk as the owner of the company. So if you buy shares in Digita, which you probably should, when you can, then what you're really saying is that I believe in this company, I believe in the potential of the company to grow, and I believe that the company will be worth more in the future. So I'm willing to participate in the risk that the company faces. And the risk that an individual company faces will vary based on the nature of the business that the company is in. So you can imagine that if you're, say for example, involved in insurance, you face one of the risks that you're exposed to is persons meeting in accidents and there being claims against the insurance policy. Whereas if you're involved in manufacturing, you face the risk of industrial accidents, you face the risk of, say for example, IP theft, all of these issues, bad batches, exactly. So that's what a shareholder does. When you buy shares, you're called a shareholder, and that's really what it means. You're undertaking the risk of participating in the growth of the company. All right. The other share is called a preference share, and a preference share is more like a loan to the business. The preference share tends to be it tends to have a quote-unquote guaranteed rate of return on it. So you'll see, like if NCB had a preference share, it would be listed as like NCB 8.75. What that means is that they're saying that they're guaranteeing you 8.75% in returns on an annual basis for every year that you hold that stock. Alright? And a company can list both preference shares and ordinary shares. You also as an investor can purchase both preference shares and individual and ordinary shares. And you can do that across multiple companies. When we talk about creating your investment philosophy and creating your investment portfolio, we like to say that for for the more secure part of your portfolio, you should probably have more preference shares. And when you speak with a licensed financial advisor, they'll advise you based on what instruments probably best suit your investment objectives. All right? So it's always good to get a hand on what your investment objective is. And there are no, say, ignoble investment objectives. So your investment objective could be to buy a car. Nobody can say, judge you for that. Whereas another person is investing for the long term. Okay? And then lastly, in terms of owning shares, one of the things that I personally advocate for I'm a value investor, and you can ask me in the question session about different philosophies or investing. But my personal investment philosophy is that of a value investor. And what that means is that when I buy shares in companies, I'm typically looking to own these shares for an extended period of time, meaning years, sometimes even decades. One of the richest investors is Warren Buffett. You all familiar with the name? All right. And Warren Buffett built his wealth by buying businesses. In fact, he says that he doesn't buy stocks, he buys businesses. And that's what I want to leave you with. I want you to look at every stock that you buy as a business. So when you buy shares in Grace Kennedy, you're not just buying the GK that runs across the ticker tape on the JSE website. You're buying Grace Kennedy's buildings, you're buying its products, you're buying the real estate that it owns, you're buying the brand equity of Grace Kennedy. Alright? And so if you have any question, I know you came in late. So any questions, I'll take them at this point.